Hi everyone. In this video, we are going to be solving one of the question from the deferred tax IAS 12. So let's see what do we have in this question. The information below relates to the financial statements of a company as at 30th September 2007. The carrying amounts has been given to us for two assets, which is plant cost less depreciation, that is 110,000. The land has a value of 280,000, but the original cost of the land was 200,000. The tax bases are given to us. For plant it is 90,000 and for land it is 200,000. The tax rate is 20%. The deferred tax liability that is already calculated in the question, and that is 20,000, and the revaluation surplus is 64,000. So what's the requirement? We have to identify the two statements which are given, that whether these statements are correct or these statements are incorrect. So what is the first statement? The amount of the deferred tax liability is correct or incorrect. So the value of the deferred tax which is given to you, which is this 20,000, right? So we have to identify whether this is the correct value or this is the incorrect value, and same goes for the revaluation surplus. So to recall, guys, how do we calculate the amount of deferred tax? We need to compare the carrying amounts with the tax basis. So when I do that, how much is the carrying amount? We need to identify that. We need to compare that with the tax base, and that would be giving us the temporary difference, right? So we've got two assets, right? We have got plant and we have got land. First of all, I'm going to be putting down their carrying amounts, which is 110,000 and 280,000. But when I look at their tax basis, so the plant is having 90,000 as their tax base, and the land has a value of tax base of 200,000. So the difference between these two, which is 20,000 in the case of the plant and 80,000 in the case of the land. Now in both of these cases, you guys can observe this thing, that the carrying amount is greater than the tax base. Okay, the carrying amount is greater than the tax base, and we have learned this thing in our class, that whenever the carrying amount for any asset is greater than its tax basis, the difference that we will be having over here, which is 100,000, these differences are going to be taxable difference. And when I multiply the taxable difference by the tax rate, which is 20% over here, I am going to be getting a deferred tax liability of 20,000, which means that the first statement is absolutely correct, because they have done the same amount of the calculation, which is 20,000 for the deferred tax liability. Now let's talk about the revaluation surplus. Now in the case of the revaluation surplus, I can see this thing, that the land value was originally 200 and now it is 280. So I have got a revaluation gain of 80,000. And again, we have discussed this thing in our class, saying this thing, that whenever there will be a revaluation gain, the carrying amount will go up, but the tax base would stay the same. As a result of which, we are again going to be having a deferred tax liability over here, which we have calculated, guys. The deferred tax liability on this 80,000 based on 20% would be 16,000. So the net amount that would go in my revaluation surplus is going to be 64,000, which means that even this statement is absolutely correct, and the right answer for this question is going to be both these statements are absolutely correct. So I hope this question will help you understand the concepts of deferred tax liability better. Thank you very much.